Hey everyone, in this video I'm going to value Lenovo Group stock and try and figure out whether it's a good deal or not. If you're new to the channel, my name is Dan. I do a lot of stock analysis and investing advice on this channel. So if you're into that kind of thing, hit that subscribe button so you can check out related videos. Alright, so this is Lenovo Group. This is the type of stuff that they're into. You might know them best from selling their PCs and tablets, but they also have phones, smart devices, and they have a data center. Lenovo Group is a Chinese company with a PE ratio of close to 11, so initially it looks like a good deal. The dividend yield is about 2.3% right now, and they are about a 9 billion market cap company. So Lenovo is really going through a growth phase. As you can see here from their latest report, they have tremendous growth in their gaming PCs. Unbelievable growth in their Chromebooks. You can see they even have some mobile revenue expected growth next year, as well as their data center with about 34% year-over-year revenue growth. They're in the Internet of Things, smart infrastructure, smart vertical sectors, and overall, collectively, you've got software and services revenue up 39% year-over-year. Now, this bodes well for the company. The PC market has expanded, possibly as a result of the pandemic. But for whatever reason, that's good news for Lenovo. Now, turning to their balance sheet, I'm not thrilled with what I see. I love the growth of the company, but they're becoming very highly leveraged, as you can see by their 87% liabilities to total assets ratio. If you don't know any of these ratios, check them out in the description below, but they paint a very risky picture of a company. Current ratio is less than 1, so they got more liabilities than they do current assets. And the quick ratio is 0.65. So if you take out their inventory, their current assets represent just 65% of their current liabilities. The interest coverage ratio is, it's not danger zone yet, but 6.44 is not excellent either. So I don't like the balance sheet at all, and I'm going to have to consider that as I decide whether to buy the company or not. So here we have a DuPont analysis. If you don't know what that is, check out my video on that in the description below. But essentially, we're just looking at return on equity, the very important measure of profitability here for a company. And we're just dissecting it into its three components. I love to look at about 5 years worth of data just to make sure I have a good picture of this company's operations, because profitability can really vary from year to year. As you can see here in 2018, they obviously had a very bad year. You wouldn't want to look at that in isolation. So collectively, the company normally has return on equity of, anywhere from -3 to 21. I think on average it looks to be about 17, maybe 18%, especially if you exclude that fluke of a year there. That's not bad. It's not great either. I really don't like what's driving it though. It's highly driven by leverage. When you look at that equity multiplier being so high, the company's asset turnover is the one bright spot here. So for every dollar of assets in place, they generated $1.64 of revenue last year. That's excellent. Unfortunately, their margins are very thin. Out of every dollar they sell, they keep 1.7 cents. I like to see the numbers going up. That is good. They're only a $9 billion company, so if they can improve that with economies of scale, if they can potentially double their net income margin, which isn't as hard as it sounds. You've got a margin of 1.7%, so to double that, you're just going to 3.4%. If they can do that, they will have an incredible ROE. So they do have room for improvement. So the company does pay a dividend. They are a growing company, but they still maintain that dividend. Again, they're yielding about 2.3%, but look at how much the dividend has grown over the past 5 years. So what starts out as a 2.3% yield can actually grow to be pretty significant here. Now in the red, we've got share buybacks, which they haven't really done very much. They probably haven't had the spare cash to do so. The good news about Lenovo is despite their high leverage, they have a pretty safe dividend. They're currently only paying out about 21.9% of what they earn every year. So they can afford to keep paying that and keep raising that dividend for the foreseeable future. Okay, so I'm looking at their growth rate here in free cash flow to equity as well as net income. Now, I pay a lot less attention to the free cash flow and equity trends because that measure is very bumpy. Companies may just use a lot of cash in 1 year to prepay expenses, or perhaps to just pay off a lot of debt, or they may borrow a lot in 1 year. So, look, if you're looking for trends, I think you have a lot more luck looking at net income, which is an accounting measure of profit, which smooths out a lot of the bumps that you normally see in cash flows. So with that in mind, look, this past trailing 12 months, their net income represented 163% of what it was just in March of 2017. So that's very good growth. We've got a 5-year geometric growth rate net income of 10.32%. Very impressive. And from the report we recently looked at, they're also experiencing growth right now. It's only a $9 billion company, so they do have a lot of room for growth. Okay, so to value Lenovo stock, I'm going to use a free cash flow to equity model. This is a very popular discounted cash flow technique. If you don't know about it, check out my video on it in the description below. We're going to be forecasting the next 5 years of free cash flows to equity. So we're going to look at next year's forecast, and then we're going to assume some kind of growth rate for the next 5 years. It's really hard to forecast beyond that. So at that point, we're going to come up with a terminal value, assuming the company can continue to generate those kind of cash flows in perpetuity, perhaps growing at a very small rate. I'm going to say they can grow them at about 1% after that, just keeping up with inflation, or even less than that, really. Now, as far as the growth rate over the next 5 years, they have grown recently, but I do see that possibly slowing down a bit. I'm going to be a little conservative here. As far as the discount rate, I will choose a higher discount rate. This is a company located in China. Therefore, they do not have as strict of standards for financial reporting. Research has shown that companies in the U.S. generally have higher financial reporting quality. So there is a little information risk with this company. The company really isn't covered by a lot of financial analysts either. So when you look at the current price, there's a lot of opportunity for mispricing. If you look at American companies, big American Fortune 100 companies, they're covered by so many financial analysts that there's a lot less information risk. They're more of a known quantity. So we are going to go with a higher discount rate of at least, I would say, 7%, possibly higher. I think 8 or 9 is more reasonable. And so let's get into it. Let's see what the value is. So here we're looking at a valuation matrix. Rather than just one value, I'm going to show you many different values of the company under different growth assumptions here, free cash flow to equity growth rate, and under different discount rate assumptions. So for example, this cell right here means if you expect a 6% growth in free cash flows over the next 5 years, and you expect a 10% discount rate is fair, the stock would be worth $18.43 per share as of today. Okay, so another way of looking at this matrix is as follows. If you think free cash flows to equity will grow at 5%, and you would like to earn a 9% return on your investment, you should pay no more than $20.42 per share. So, when we look at the current share price, is it a good deal right now? Well, that's what this matrix below is going to tell you. I've kind of color-coded it. If it's undervalued, it's highlighted in green. If it's overvalued, it's in red. So in the most optimistic scenario I've listed, it is 77% undervalued. Now that's pretty darn good, especially because we're only assuming a 7% growth rate in free cash flow to equity. If you even assume, let's say we have lower expectations for our growth rate, there's still a lot of scenarios where it's a good deal. See, I just changed the numbers there, and you still have it highlighted in green in most of these cells here. Now, which cells should you be paying attention to? I'm going to change that growth again back to 4. I think anywhere from 4 to 7 is reasonable. I think really, though, you should be really focusing on 9 or 10% rows here. I think that's a fair discount rate given the risks of this company. But even with those rates, you still got a good deal. Okay, so here are my final thoughts. Normally, I would look at insider trading data, but we don't have that available for this company on the website I like to use, which is nasdaq.com. So absent that data, I have to give a recommendation. I'm going to say buy, and I'm going to say don't go all in on this one. This is just one of those stocks you want to put some of your portfolio in to manage your risk, because it could turn out very badly for you. The company is highly leveraged. They are located in another country with rather weak accounting standards, so there is always the possibility that the numbers they're reporting do not reflect the truth. Now, that may seem unlikely for a lot of young investors, but just understand that happens sometimes. Companies have to restate things. They say, "Oops, we had the wrong numbers there, and we weren't as profitable as you had thought." This isn't really a risk you think about when you're looking to invest in like the 3M company or Coca-Cola, but this is a real risk for smaller, especially foreign companies. So don't bet your retirement on it, but for me, yeah, I'm going to put some money into this stock today. That's just my thoughts on it. It's just my opinion. I hope you enjoyed the video. If you did, hit that like button. It helps me a lot. Thanks for watching.